Today, we are diving headfirst into a massive puzzle at the very heart of the global economy. Seriously, everywhere you look, the market is sending signals that completely contradict each other. It's like a mystery with a bunch of conflicting clues. So let's see if we can piece this thing together.
And that really is the core question, isn't it? Why does it feel like Wall Street is throwing this huge, euphoric party with markets hitting new highs when so many warning lights are flashing red? This level of optimism, well, it has some pretty serious historical parallels, especially to the dot-com bubble. And that's what makes this whole situation so fascinating and, honestly, a little bit unnerving.
And boom, right out of the gate, you see the central conflict. On one side, you've got the big money, the professional, institutional investors. They are showing what analysts are calling extreme bullishness. They are all in. But on the other side, everyday individual investors, they're feeling a growing sense of fear. It's this massive psychological split that is the key to understanding this entire story.
So our investigation has to start with the most fundamental layer of all this confusion, the economic data itself. The numbers that are supposed to give us a clear checkup on the economy's health. Well, right now, they're giving us two totally different diagnoses at the exact same time.
So let's start with the good news. The International Monetary Fund, the IMF, they've actually revised their forecast for global growth upwards. They're now projecting a pretty solid 3.3% for 2026. On the surface, that looks great. It's a sign of a tough, resilient global economy, a real reason to be optimistic.
But, and this is a big but, that optimism is not the whole story, not even close. At the same time, the World Bank is painting a much more cautious picture. They're specifically forecasting a slowdown for emerging economies. So right there you have a tale of two economies, one that looks strong and one that looks pretty weak, happening side by side.
And here, this is just a perfect illustration of the whiplash you can get even inside the world's biggest economy, the United States. In the first quarter of 2025, the GDP actually shrank a tiny bit. But then, in the very next quarter, it came roaring back with a strong rebound. A lot of this volatility we're seeing is being driven by these unpredictable trade policies and tariffs, which have gone from just a risk on paper to a real disruptive force in the economy.
Okay, let's move on to our second clue. What we're looking at here is a high-stakes standoff, a real game of chicken being played between the financial markets and the U.S. Federal Reserve. And believe me, they have very, very different ideas about what should happen next.
What's just fascinating here is how certain the market is. Traders aren't just hoping for a rate cut. They are betting on it with overwhelming conviction. They've priced in an 85% probability that the Fed is going to cut interest rates in September. They're looking at things like weak jobs data and thinking, yup, it's a done deal.
And here's the massive disconnect. This is a direct quote from the Fed's own official meeting minutes. While the market is absolutely screaming for a rate cut, the Fed's own members are saying almost unanimously, nope, we support keeping rates exactly where they are. Someone is going to be proven very, very wrong here, and that could send a huge shock through the whole system.
Now this brings us to the psychological heart of this whole mystery. It's not just about data points or policy decisions, it's about how people are feeling. And right now there's a Grand Canyon-sized gap in sentiment between the professional investors and the general public.
Just take a look at this. According to a big survey of individual investors, almost 44% of them are bearish. That means they expect stock prices to fall. Now that is way, way higher than the long-term average of about 31%. Main Street is feeling cautious, really cautious.
Okay, now contrast that feeling with this number. 25 years. That's how long it has been since the big institutions, the huge funds and banks, have put this much of their money into stocks. They are more bullish, more optimistic today than at almost any point in the last quarter of a century.
And putting that extreme optimism into historical context is, well, it's pretty sobering. This timeline shows the last few times institutional bullishness peaked like it is today. In 2000, right before the dot-com bubble burst. In 2007, right before the global financial crisis. And today. It's a pattern that historically has not ended well.
Our fourth and final clue might be the weirdest one of all. It shows that the disconnect isn't just between different groups of people. The market itself is fundamentally divided, with its own internal signals pointing in completely opposite directions. Here is a perfect example. You have the S&P 500, which represents the broad market, and it's charging ahead to new highs. That's a classic bullish signal. But at the exact same time, the tech-heavy Nasdaq is flashing classic bearish warnings, technical patterns that suggest a big reversal could be coming. It's like the main army is advancing, but the elite tech troops are starting to sound the retreat.
So let's look at the actual numbers the analysts are watching. For the S&P 500, the trend is still considered bullish as long as it holds above that key support level of 6,100. But for the Nasdaq, technical analysts see a potential bearish target way down at 22,600. That is a completely different and much scarier outlook.
And it's not just in stocks. Check out commodities. Gold, the classic safe haven asset, is surging as investors are rushing for safety. But at the same time, the price of oil, which is super sensitive to economic growth, is falling because of fears of a global slowdown. You see the problem, right? You can't have a fearful economy that needs safety and a booming economy with high demand at the same time. One of these signals is wrong.
Okay, so we've gathered all the clues. A divided economy, a standoff with the Fed, a massive split between Wall Street and Main Street, and a market that's basically at war with itself. So what on earth does it all mean? How do you even begin to navigate this incredibly complex environment?
Well, that combination of rising gold, which signals fear about inflation, and falling oil, which signals fear about slowing growth, points to one particularly nasty risk: stagflation. It's this toxic economic cocktail we haven't really seen in decades, where economic growth slows down, but prices for everything keep going up. It's the worst of both worlds.
So, when you boil it all down, it's about being really aware of three big risks. First, the Fed makes a mistake. They don't cut rates like the market expects, and that causes a huge tantrum. Second, what you could call a psychological whiplash. That extreme optimism from the pros just evaporates, and suddenly there's no one left to buy the dip. And third, these ongoing geopolitical shockwaves from things like unpredictable trade policy. So how do the pros handle a market like this? Well, the strategy completely shifts. It's less about making big, broad bets and more about making careful, selective moves. That means hedging your portfolio against uncertainty, maybe with assets like gold. It definitely means reducing debt and financial leverage to protect yourself from a sudden drop. And it means focusing on picking specific, strong companies, not just betting on the entire market to keep going up. And that really leaves us with the final big question. With so many conflicting signals pulling in every direction, finding clarity isn't about just picking one story and ignoring everything else. It's about understanding that the contradictions themselves are the story. Real clarity right now comes from acknowledging the deep uncertainty and preparing for a future that could still go in almost any direction.